All righty. Welcome, everyone. I'm Jeff Dobines, President of Southwestern Investment Group, and thanks for joining. From time to time, we like to have these educational seminars. We're getting questions from when's the market going to get better? So it's done really well now. So now people are wondering kind of when's the bottom going to fall out, and it's kind of this age-old cycle of how to ensure that we're well positioned for whatever the market's going to do here with the new administration and coming out of COVID. So we're grateful for you joining. A couple quick things. We're going to have a little background just on the market and these historical corrections by Drew Mcmillan, who works with our team. And then we are going to have about a 20 to 30 minute presentation from Nick Lacy. So I'll introduce Nick in a second, but Nick, thanks for joining us. You guys will really be inspired from his insight. He's finally back in the office at the headquarters in St. Pete for Raymond James. So the world is getting back to normal in some degrees. And then we will have Q&A. So we'd love to have folks ask questions. And so there's a box in here somewhere, if you're familiar with Zoom, on how to ask questions. So if you would please do that as they come. And then Drew will run the question and answer at the end of the session. And we'll do our best to answer each question, and if we don't get to them, then we're going to save those at the end, and then we'll get back to you individually. But our hope will be that we'll get to each one of those. So I would like to introduce Nick briefly because Nick has been a dear friend and a really exceptional, intelligent leader in asset management for our team and for the whole group at Raymond James. So Nick's the Chief Portfolio Strategist for Asset Management Services at Raymond James. They have a team of about 300 people. They manage over $60 billion in their programs, and he's responsible for making the decisions with the committee on how those monies are managed, which products are allowed in, and which ones are removed from the different models. So Nick is extremely intelligent, but he's also a great communicator and has quite a sense of humor too. So he's the whole package, which is unusual for these chief investment portfolio strategist folks. They tend to not be allowed out of their closet to communicate with people. So Nick has an MBA from the University of Tampa. He's a chartered financial analyst since 2005, CFA, SEMA, spent 10 years at T. Rowe Price before he's joined Raymond James. So he's a dear friend, and we're grateful for you, Nick. So thanks for being here. I want to also introduce Drew Mcmillan, who works with the Southwestern Investment Group. And so, Drew, if you would please give us a little insight into what these market performances has done for the last 70, 80 years.
Yeah, I'd be happy to. And one other quick note before we start here, there's a Q&A button. So feel free as you can go ahead now, or as Nick's going through his presentation, submit questions. Some of these we might answer through the chat. Others we might wait and ask Nick at the end when he's done. He'll wrap up a few minutes early. So we'll have some good question and answer time. So don't hesitate to fire away at some questions down there. But before we hand it over to Nick, we wanted to share a couple things that we've been looking at here as a group, because we've started to get some questions just about what the market's recovered and it's surpassed highs that it was before the COVID crash, and when's the next crash going to happen? That's the natural question that happens. Anytime we surpass a new high, it's a natural human inclination to say, well, when's the drop going to happen? Because obviously that's, certainly what happens next. And so we want to share some perspective here. I've got a couple of just quick slides I want to go over. And there's a saying that history doesn't perfectly repeat, but it can oftentimes rhyme. And so, history is our kind of best judge of what we could expect going forward. And so, a couple pieces that we have found and going over with people has been very helpful is just looking at what do the next few years look like after some pretty serious drops in the market. And so this was an interesting piece dating back to 1949, that the average bull market, the average run up in the market has lasted 72 months and has just shied average total return over those time periods has been almost 300%. Whereas the average bear market, the drop has been about a 33% drop in 14 months. So the average bull market typically lasts 5 years longer than the average bear market. So we're 1 year removed, about 50% or so up since the bottom of the market. And so history would tell us that we actually have quite a bit more room to run in the recent market recovery. And the second chart hits on this even more. It went back and looked at the 5 biggest market declines since 1929, and then what did the next 5 years look like? Let's broaden our horizon to look at the next 5 years. So you see these huge drops, you know, the depression of 86%, 60%, et cetera. And then the blue is what the first year was, and then the second year after that, et cetera. And interesting, out of the 5 biggest drops ever, there were only 2 years in the subsequent 5 years. So that's, you know, 25 total years. There were only 2 years there that experienced a drop. But even regardless of the drop that these 2 periods experienced, this average annual total return of the equity markets since those big drops, they were all big, 35, 20, 17, et cetera. So looking at a 23% average annual total return. And so it's not surprising for us, obviously, to experience size bear market we did, and then experience such a run up that we've experienced, looking at this average, you know, 12-month return afterwards of 70%, and then looking at the subsequent few years. So, you know, of course, the disclaimer is anything can happen, but history says that we have quite a bit more room to run in this bull market. So hopefully that's hopefully that sets the stage for some good news. And I'm going to hand it over to Nick. Nick, thank you again for guiding us here and your partnership in all this. I'm going to stop sharing my screen. I'll hand it over to you, Nick.
All right, I appreciate that. And look, we'll go through some things, and what I'll do is I'll spend 2 minutes saying what I do for a living, because it might be important to put things in context. But I also want to share some insight on some of the things that we do, some of the things that we watch, where we see some opportunities, where we see some risks, and what we've been doing. And I think it's important to understand drivers of those decisions. And Drew, I think you mentioned it early on, ask questions. I mean, this is far better when it's a conversation as opposed to a monologue. And please type your questions in. I can probably guess what some of the questions are, which is good. So give me 15, 20 minutes maybe of giving you some details, and then we'll open it up and see what questions everyone has. Let me share my screen. Here we go. Drew, give me a thumbs up if you can see my objectives. All right, perfect. So here's what I'm thinking. Let's talk a little bit about the vaccine, because you got to talk about COVID and the vaccines, because it's important. But I want to talk about current markets going forward, some big questions, and what those things mean. Now, my role at Raymond James is really, call it 3 or 4 different jobs rolled into one. My first job is helping our team of analysts oversee our home office portfolios called Freedom. So my day job is helping manage our Freedom portfolios, which is where we're trying to put together different asset classes with different return expectations and different risk expectations into portfolios. That's where I spend the majority of my time. The second thing that I do is I help make recommendations for investments to advisors on behalf of the firm. If somebody wants to know, where do we like today? Do we like US investments? Do we like European investments? And if so, why? And I kind of go through all that as well, and then a bunch of other stuff. But I want to spend some time on some big ticket items, such as just the stock market in general. And I think the longer perspective we have, the easier it is to look at the stock market, because you take a step back away from the day to day. And just since 2010, you know, the market goes up a lot more than it goes down. And even though we had a pretty bad quarter last year with the first quarter, the markets have recovered. And that's the point that I always try to get across, is every time the market has ever gone down, it's always come back. And as long as investors are diversified, market declines are only temporary setbacks. And I think what we want to make sure that we understand is, what does that downside look like? And not necessarily when will it happen, because we can never forecast that. We can just basically say there's a higher probability for a drawdown now, or a lower probability, but it doesn't mean you know what's going to happen. The other thing that I would say, 25 years of doing this, and I can tell you that all-time highs happen almost every year. It means nothing. What we want to be careful of is when valuations are at an all-time high, because that's problematic, and we're nowhere near all-time high valuations. Simply because the price of the market is up doesn't mean anything unless the value of the earnings of the market are not up. And we're going through an earnings surge right now. I do want to have a conversation on risk, because I've spent a lot of time studying risk, understanding risk. I studied risk in school. studied risk as a professional, and I want to basically describe risk two different ways. The first way is volatility, and volatility is kind of the regulator's point of view, and volatility is how much something goes up and down. And we can measure this up and down, and what I'm showing on the screen now is something called the VIX, which is VIX, and that is supposed to represent the current volatility or the implied volatility over the next 30 days for the US stock market. And it is at this point about at average, a little above average, but when things go wrong, volatility typically rises above average. However, what we'll note is over the last 10 years or 20 years or 30 years, you never really run average volatility. You run above average volatility when something's going wrong and below average volatility when everything's okay. And it's kind of a dual personality that the market tends to present. But rarely in my 25 years of doing this have I encountered an investor who says, I get nervous when I make too much money. But that's the definition of volatility, because in this example, it doesn't matter if markets go up or if markets go down. Volatility is indiscriminate about prices going up or prices going down. I would basically make the statement that investors really care about losing money. Investors really care about, hey, Nick, if something were to go wrong, how much do you think my portfolio could decline? And that's a much better definition of risk, because that's how financial planning is designed. You know, the whole idea of financial planning is, am I going to be okay to do what I want to do? And how much market loss can I take? And can I recover over the time period that I need? And it is easier to estimate downside risk than it is to estimate upside return potential. And I'll give you an example. I ran this analysis a couple of years ago, and this is the chart that I have on the screen now, where I looked at 30 years of monthly returns for the US stock market, really the S&P 500, which is the big mega cap companies. And I basically said, what are the worst 18 months over the last 30 years? Now, this was before last year. And what I found, and you can see that light blue line, is that on average, those 18 months saw a loss of about 9%. The way you can interpret that is 5% of the time, the S&P 500 loses about 9% in a month. It doesn't happen often, but it happens about 5% of the time. And you can use that as a statistical probability by saying there's a 5% probability the market's going to drop 9%. Now, that's not a great way to look at risk, because what you really want to know as an investor is, well, if the market drops, what's my portfolio going to do? So a better thing to do is look at those 18 months and look at all the different investments and ask yourself, what did each of those investments do during those 18 months? And that's what I've displayed here, is I've shown each investment's average return for those 18 bad months, and I still sorted it from best to worst. So let's instantly go to the worst. During those 18 bad months, small cap stocks and emerging market stocks typically lost the most money. Well, if you've invested for any time period over the last 10 years or the last 20 years, you've experienced the fact that small caps tend to be more risky and emerging markets tend to be more risky. And on average, they lose about 125 to 150% of the market. So if the market's down 20, you would expect small caps and emerging markets to be down 30% or maybe more. And those are the kind of things that we want to understand. If you look at investments such as international equities, it's the MSCI EAFE, EAFE, and the EAFE just stands for Europe, Australia, Far East. It's essentially the developed world outside the US. So the international markets and the real estate markets, which are REITs here, have about the same downside potential as the US stock market. So if we have the markets down, international stocks and real estate stocks tend to be down about the same. So as an investor, what you want to know is they have about the same downside potential. Which one do I think is going to make more money? Whereas with small caps, it has more downside. So you want to make sure that you're not just getting compensated equal. You want to get compensated more because you're taking more risk. If you want to know what investments typically rally when that's a bad stock market, the answer is high quality bonds, specifically US Treasuries, but high quality bonds tend to rally in an environment where the stock market is down a lot. As a matter of fact, you looked at the last 50 years and you looked every time the market was down more than 5%, 95% of the time, treasuries are rallying during that time. And that's because it's a flight to quality. You know, if it's a bad market, it's going to end up being a bad economy, and the Fed's going to step in and lower rates, and bonds typically are going to rally on that. The problem with treasury bonds or high quality bonds today, they're not paying anything. They're paying less than 2%, which is below inflation. So you're not really going to make much money, but you don't buy high quality bonds to make money. You buy high quality bonds to diversify a portfolio against equity losses. Now, if you want to buy a bond where you can make more money, like high yield bonds, we also call those junk bonds. The problem with a high yield bond, you might make 4% more in yield compared to a treasury. But historically, when the market's down, high yield bonds tend to be down also. As a matter of fact, they tend to be down about, call it 60 to 75% of what the stock market is down. And I think it's important to understand it's not just about how much money do you think you're going to make. It's if something were to go wrong, how much money am I likely to lose? And for us as an investment committee, that's always the conversation we have. If things work out the way they're supposed to, how much money do we think investors are going to make? And if something were to go wrong, how much do we think they're going to lose? And is it okay? Is that okay? And I'm going to kind of talk about the markets and the positioning stuff now, but I think it's important to understand that framework. It's always about if things work out, how much are you likely to make? And if something were to go wrong, how much are you likely to lose? Risk is more predictable than returns. Now, this is our current positioning, and I'm going to come back to this in a second because I want to walk through why we're overweight equity today, why we're underweight fixed income. What data are we looking at to basically say, hey, the market's at all-time highs. Why do we think investors should own a little bit more equity? Why do we like U.S. equity so much and we don't like international equity? And how does that actually work out with what we're seeing? So I'm going to walk through a couple of these things. First one, you can't talk about stuff without having a talk about the pandemic. And just two things on the pandemic. First of all, the number of new cases here in the U.S. continues to fall. We've had a recent spike, and the spike is really with the younger population. I think they're going a little stir crazy, and you're seeing a spike in new cases. However, since the younger folks tend to be a little bit healthier, a little bit more resilient, the number of deaths are falling dramatically, and I think that's the positive note. It's hard to keep kids inside for so long, especially college-age kids or the 20-year-olds. I think they're getting a little bit of fatigue of being closed in too much. Just simply turn on the TV for spring break and you can see what's happening. But while cases are rising, deaths are falling. Deaths are falling dramatically, and I think inevitably these numbers are going to start turning radically. And all you have to do is look at what's happening with vaccinations. And, the U.S. is going through a dramatic increase in vaccinations. And the number of people in the U.S. that are vaccinated is rising dramatically. And if you look to the right, this looks at the U.S. relative to other major countries and what number of people per million are currently vaccinated. And this is as of last week. And the U.S. is leading the world on the number of people vaccinated per 1 million. We're sitting at 10,000 people per million. At this pace, the way things are going, it might be mid-June or maybe even early July until the majority of people who want to be vaccinated are vaccinated. And I think that'll be a huge milestone. But it takes time. It takes time. In Florida, we've been vaccinating people at these giant FEMA sites where you don't even need an appointment. You just drive and get in there. And now younger people are being able to get vaccinated as well. I'm not going to spend a lot of time on economic growth stuff. I will just say we had the worst economic growth last year we've had since basically World War II, which means this year we're going to probably have the best growth we've had in maybe 30 or 40 years. And it's a bounce, right? It's a bounce back. And we're going to keep growing the economy because the Federal Reserve, and we're going to talk about this, is likely to keep interest rates near zero well into 2023, maybe into 2024. So what makes us excited about owning equities? Well, part of it is it's the jobs market. It's all about are we getting better or are we getting worse? And for the unemployment rate, it got really high, but really quickly it came back down. And every month it's getting better. Now, keep in mind with the unemployment rate, the Federal Reserve used to say 10, 20, 30 years ago that the natural level of unemployment is 5%, meaning you just have this level of people that are going to be unemployed because they're between jobs, they're moving, whatever the case happens to be. But because of how remote things are and how much more efficient things are, the Fed now believes that the unemployment rate is actually more like 4%. So don't expect the Fed to do anything as the unemployment rate continues to fall. And you can also watch jobless claims or continued claims, but everything's getting better. And I think that's what we want to see. The second thing that we're paying attention to next to jobs is the economic cycle. Are we expanding or are we contracting? And it's really hard to know because economists don't know until 45 days after the quarter ends because it's a big economy. So we won't know until mid-May whether or not the first quarter we saw an expansion or contraction. So we have to look at indicators. And one of those is something called the leading economic indicators. And it's on the left. It's a basket of 10 items that looks at behavior to see if the economy is expanding. And as we can see, the economy is expanding, and it's expanding at a good rate, which means this year is likely to be a very strong year. And I think the current estimate this year is around a 7% growth in the US economy. And other things that you can look at are the Purchasing Managers Index or the ISM Index, which is basically a survey of professionals that says, you know, are you doing more business now or less business? Manufacturing, non-manufacturing. And we're getting to the point that we're getting some of the highest readings we've had in a very long time. And this is another indication that the economy is continuing to improve. So two things, right? The labor markets are getting better and the economy is expanding, and it looks like it might be accelerating. So what's the third thing? And this is the one that I probably get the most questions on, which is, well, of course, with all of this stuff happening, we have to have inflation. The answer is, yeah, the expectations for inflation have risen. And let's spend a minute talking about it. There's inflation that we've actually experienced, and then there's theoretically what might happen. So theoretically, what might happen is what everybody's talking about. And I put that on the left. I call it break-even inflation. And break-even inflation is what the market is betting on. It's what the market's betting on. And it's a 5-year bet or a 10-year bet. And it's by looking at the Treasury inflation protected securities or the TIPS. It's what's priced into those. And you can see from February of last year to now, those inflation expectations have risen because they were near zero. Now they're at about 2.5% over the next 5 years. So if you wanted to know what is the market betting on for inflation for the next 5 years, the answer is it's about 2.5%. Now I think that's an overestimate. I think the market has overestimated the level of inflation. And if you look at what has actually come through, you're talking a little bit under 2%, but it's starting to escalate. We saw some readings come out on Monday. I haven't included it yet, but it was around 2.5%, 2.6%, because it's looking at prices a year ago in the depths of the pandemic. So we're going to see a few months of elevated inflation, and then you're going to see inflation come back down again. Our estimate over the next 5 years is 2.2%. That's where we think inflation settles. Might be a little higher, might be a little lower, but I don't anticipate it being much higher than that. So why is that? Why do you hear about so much inflation expectations where we think it's going to be 2.2? You know, you have all these media outlets screaming about, you know, you got to do something about inflation. Here are 3 things that people are typically talking about. They're typically talking about the amount of money that's been put in circulation, right? There's been a tremendous amount of money. The Fed has purchased billions upon trillions of dollars worth of debt. We've done a tremendous amount of fiscal spending. So you look at the elevated levels of debt as a percent of GDP, and people point to that and say, aha, I told you, we got a lot of debt, so we're going to have inflation. Or people might say, you know what, there's a huge amount of savings. So as soon as people put that savings to work, we're going to have inflation. So all of these different things that people point at are basically things that could theoretically drive inflation, maybe. But let's dispel most of these. The money supply growth, remember the Fed holds those bonds. That money is not in circulation. They own those bonds. It's not in the public. So growth of money supply does not equal inflation. How about government debt? Does the size of the debt matter, or does the servicing of the debt matter? And this is something we always have to be clear about. When you buy a house, it's the mortgage payment that matters. It's not the price of the house. And when rates are low, you can afford a more expensive house, or the house that you buy is going to cost you less every month because your mortgage rates are higher or lower. With the government debt, it's the same way. The size of the debt has increased dramatically, but the debt service, or what we're paying in interest, has fallen tremendously, simply because we're issuing bonds at below 2% interest, which we hadn't really done before, at least not at these levels. And then the buildup of savings, will people all of a sudden just start spending a bunch of money and boost prices? Probably not. Probably not. So why do we think the equity markets are going to do well? We do think that there is a little bit of inflation, but not rapid and not a lot. Don't think about these next 3 months. Think about the next 12 months, the next 24 months. The Federal Reserve has been buying bonds. They have almost $8 trillion now in their balance sheet. At some point, they're going to slow down bond buying. They're going to call that tapering. We love words that give these things tapering. That's their word. But we look at it from the perspective of what are companies doing from a sales, earnings, and dividend growth perspective, and are they doing better or are they doing worse? So in the US, the way to read this, if you look at US large, this is simply analyst expectations that the US is going to grow its earnings this year by over 26%, which is a huge number. Last year, we basically grew our earnings at a negative rate of a negative 11%. So it's basically we're back and then some. The most important thing is, are they getting better or are they getting worse? A month ago, the expectation was we were going to grow our earnings by 24%. So it's getting better. And all you have to do is look at the surprises. This basically says, how are companies reporting their earnings? And is it better than expected or worse? And essentially, the US companies, large caps, mid caps, small caps, all those, the earnings that are coming in are above expectations by a wide margin. Statistically speaking, it's the best ever. Companies have never surprised the market better than they have now. And this goes back to the technology era and the crash and recovery and all that. Companies are in really good shape there. I'm not going to go through all these earnings things because it's a lot. But just quickly getting to bonds. The big driver for the bond market is going to be what the Fed does. The Fed basically said they are not going to change interest rate policy until the second half of 2023 or the first half of 2024. So they're not going to touch short-term rates. However, 2-year rates, 3-year rates, 5-year rates, they can all get higher. They can get higher, and that's exactly what's happened. If you look at the 10-year bond, back last summer, it was about 0.5%. Where is it now? Well, it's about 1.7%. We're back to where we were in late 2019. So we're kind of back to somewhat normal, but we're nowhere near to 3.25% that we were back in 2018. And it could take us 5 to 10 years to get back there. It took us a long time to get there. Remember, they just started raising interest rates in 2015, and it took us until the end of 2018 to see that level above 3% like that. Muni bond yields, or tax-free bonds, those yields actually haven't risen. And the reason for that is because taxes are probably going to go up. And if taxes are probably going to go up, municipal bonds being tax-free become a little bit more attractive. So you get more people buying those. All right, this is my last market chart. And basically the slope, the one on the right, that simply looks at the difference between short-term bonds and long-term bonds. When the difference between longer-term bonds and shorter-term bonds is big like it is now, it is usually an indication of a risk-on market. When you have the difference between a 10-year bond and a 2-year bond 0 or negative, it's usually an indication of a risk-off market. And if you look at the summer of 2019, we had negative sloping rates, meaning the 10-year bond was selling for a yield below the 2-year bond. And that's a signal that the market has no confidence. Right now, the markets are very confident. So let me move on from some of these slides here to basically get to just positioning, positioning last year and then where we are now. When we came into 2020, I had mentioned that the markets were kind of negative. They were saying, the growth is falling, the Fed's cutting rates, things are looking kind of unusual. So we basically took the position that we should be underweight equity and freedom and overweight bonds, because we thought, it's probably not a good environment to be overweight equity when you have these kind of bad signals. This is before we heard the word COVID. This was simply based on the economy and the markets. But what we ended up seeing last year, about mid-May, things started to get better around mid-May. So we decided, you know what, let's start selling some of those bonds and buying stocks, because it's the right thing to do. And we started selling international markets because we felt the US was ahead of the game. We felt like we really had a better footing here. So sell some of those international companies and bring them back to the US, add investments to some of the more risky parts of the market, like small caps and mid caps, because they had gotten beat up so much. So that was kind of what we were thinking in May and June of last year. But where are we now? I probably should have put this at the very end instead of front loading it. But this is where I'm going to stop, and I'm going to turn and see if Drew has any questions for me. Let me get to this chart. Sorry, should have put this in. So what did we just do this year? So 2021 to us was a better year for the stock market than the bond market, simply because the bond market we felt was going to face challenges. Why? Because yields were low and they had only one way to go, which is higher. So we felt this is a good opportunity maybe to sell some more bonds and buy some more stocks. Specifically, we put money in US stocks, specifically large cap stocks. We also added some money to some more equity type bonds, like high yield bonds and emerging market bonds. We reduced some of the non-traditional investments because we really do think that these next couple of years are going to be better for equity investors. And I'll leave you with the saying, don't fight the Fed. The Fed wants to push asset prices higher. And when is the next downturn going to come of significance? It's when the Fed starts tightening. Remember, the Fed started tightening originally in 2015, but they only tightened once and they waited a year to start tightening again. Ever since the Fed started tightening more seriously, the market started to struggle. We're looking at 2024 as probably that time when the Fed gets a little bit more serious about tightening. So let me pause there and see, Drew, what kind of stuff can I answer? What are you getting asked? What are your clients asking you?
Yeah, thanks so much, Nick. So we've got a couple questions so far, all relevant. You touched on the government debt, but specifically there was a question that, is there a correlation between the high quality bonds you referred to and the government debt? Are they correlated in any way at all?
Well, they are the same thing. I mean, that's what they are. If you look at the size of the debt, right? This is what we were showing earlier. Oops, I went the wrong direction. Sorry. If you look at the size of the government debt, to GDP, it's about 130% debt to GDP. Well, the debt that the government has it's Treasury debt. It's short-term, intermediate-term, long-term debt. And when you look at the bond market in general, just the general bond market, it is the debt market. It is part government debt, part corporate debt. It's all related. Now, as far as correlations are concerned, here's the correlation. When interest rates rise, bond prices come down. That's kind of what happens. Now, what we saw happen just recently was the fact that bond prices only came down on intermediate and longer maturity bonds because the Fed controls the short-term rates, and short-term rates are still zero. And the Fed's not going to change that for years. So the only thing that could move was that 10-year rate, that 5-year rate, et cetera. And that's what we saw happening. We saw rates back up. And I'll go right to this 10-year chart again. And that's what we see here. This is the 10-year bond chart. And, Drew, you could take two approaches. You could say, oh my gosh, the bond market just got obliterated. It's down 5%. Or you could say, hey, yields are back where they were a year ago. That's good. And I think it just depends on what message you're trying to sell somebody. And remember, on TV, it's all about selling somebody something. They're selling something, advertising. I would just say yields are where they're supposed to be, and I would expect yields to stay here for a while. I think 5 years from now, maybe we get a 2.5% 10-year Treasury, maybe close to 3%.
Great. Okay, good. Thank you. Hey, a question. Obviously, the tech sector made all the news last year. So what do you attribute the tech sector, the NASDAQ, the outperformance compared to the overall market, and how does that impact investing and allocation decisions?
Yeah, the technology sector last year, just like some of the consumer discretionary parts of the market, were very defensive last year. And we talk about the market being bifurcated between defensive sectors and cyclical sectors. And when you hear these words, defensive essentially means their revenue and earnings are not as tied to economic activity. Cyclicals are very tied to economic activity. And these things evolve over time. So technology stocks might be cyclical, but in this environment, they're very defensive because those types of companies benefit from this migration of work from work to work from home. And this migration's not done. This infrastructure is going to continue to be built out for years and years. However, if you look at those companies that are very cyclical, those are companies like energy, materials, industrials, financials. Those are things that require the economy to be hitting on all gears before, or I guess all cylinders, before they start to do very well. So if you look at what's happening this year, that's what you see. You see a much more broad recovery this year in the market. And as a matter of fact, energy stocks are up something like 30% this year because they had gotten beaten up really badly last year. But you also have an economy that's starting to reopen and reemerge. Financials are up almost 20% this year because now you have yields steepening, and banks need steep yield curves because they borrow on short money and they lend on long money, and they earn that difference. They earn that spread between long and short. And when the spread between long and short is narrow, they don't make much money. Going forward, Drew, I would say my best guess is the difference in returns between these various parts of the market are going to be closer. Last year, those differences were massive. It was basically 10 companies ran the market last year. This year, you're going to get a much more broad-based recovery, and you already see that happening. And I think you're likely to see the difference between these returns being much, much smaller. The market's up about 10.7% this year. Mid caps and small caps are up 16 or 17% this year. And value's up a little bit more than growth, which is good because it's really been trailing an anchor for a while. But the difference in returns are closer. It's not like one's up 10 and one's up 30. These things are all getting, and so that benefits diversified investors because everything kind of works.
Yeah, I was going to say that it's a diversification case, right? That growth was up significantly last year, but then we've seen this turnaround this year, and so not just like not chasing companies, not chasing industries as well.
Yeah, and it really started late October. That's when it really started. We really saw this bifurcation between the cyclicals and defensive start to separate themselves in the other direction. And a lot of it, believe it or not, was tied to the election results. They thought, hey, we're going to have a new administration, therefore we're going to get a lot of fiscal spending. We're going to get all these things that are going to juice the economy in the near term. And the market's like that. And you saw this huge rally in small caps, mid caps, dividend stocks that all started around mid-October and has been on a tear for about 6 months. But it is starting to slow down a little bit, which is fine because everything's doing okay.
Right. Well, you mentioned the election, so this is a good segue. We've gotten a couple questions just about new administration, stimulus checks. China had a article in the Wall Street Journal talking about how they're equal to the U.S. now. So big picture political stuff going on. How do you see that impacting markets, and how are we positioning portfolios to prepare for that?
Yeah, there are a couple of things. So first of all, the inflation story is a good story. And I think what we want to be able to talk about on the inflation story is inflation expectations are higher than they were, but they're more normalized. They were very low. Now we're at very normalized expectations for inflation. So as an investor, what do you do about that? Well, what we did is we basically sold some bonds and bought some stocks. That's the best thing that you can do if inflation expectations are rising. Now, if you have an inflation shock, that's different. If inflation hits 4 or 5%, the only thing you can do is buy gold and cash, and that's it, and maybe some ammunition. I don't know, but that's that's the low probability event. The higher probability event is that inflation spikes for a couple of months and then settles back down somewhere between 2 and 2.5%. And owning stocks works. The amount of fiscal spending that we're getting is one of the reasons why inflation expectations have risen. That's why it started rising towards the end of last year when the election outcome was more pronounced. Now, what you're likely to get with this administration, we've already seen it, right? It's a lot more spending, but you also have a lot of pet projects. Expect to see a lot tighter regulations and reform in financials, in energy, healthcare. But remember, the margins are so slim in Congress that, you know, unless you get every single Democrat to vote in the Senate, you're going to have one or two people that basically are going to ask for the world, and they're going to get it because you need every single vote to avoid not passing anything. We saw the elimination of the Keystone Pipeline day one. You know, that was a campaign promise. You knew that was going to happen. And then, you know, once again, there are consequences to elections. Taxes are going to go up. That's you know, consequences to elections. Taxes are going up. When and by how much, don't know. But we do know they're going higher. But it has to happen this year. It might not go into effect until next year, but it has to happen this year because next year is another election year. And every first-term president loses seats in the midterm election. So if you know you're going to lose seats in the midterm, you better get through whatever you think is controversial because it's not going to happen come next November. So that's kind of what you're looking at. And then it'll be 2 years of probably nothing except executive actions because that's kind of where we are. Public relations, I don't think you're going to see any difference to how we treat China. The Biden administration and the Trump administration both have a very similar view of China. How they speak publicly is different, but they think very, very similarly. And while China is not our enemy, they're definitely not our friends. And, you know, they are a command, you know, based economy. They are a communist economy with some free market components, but they're not the ones that freak me out. The ones that freak me out are the Russians because they're the ones that are willing to do just about anything. And when you talk to policy advisors, they'll tell you the Chinese are not our friends, but they don't make me nervous. The Russians make me nervous. And these are administrative policy advisors under the Obama administration, under the Bush administration. We haven't met with anybody yet under the Trump administration yet, but I'm sure they'll be on the research circles pretty soon.
Great. We've got a question about the recent $2 trillion infrastructure bill and how that investment may impact certain companies and sectors when materials, things like that become attractive. How are we looking at all that?
Yeah, ideally, first of all, something has to actually pass into law. And you have to have some concrete information, and no pun on the word concrete, because that's really what infrastructure spending is, it's concrete. From what we were seeing, this is a very long-term spending bill, meaning this doesn't happen in 2021. This happens over a series of years and years. And because of that, the impact is relatively small because you're not getting a tremendous amount of spending all at once. It gets basically trickled out over several years. But ideally, materials companies would benefit, you know, steel producers, industrials, and you've already seen them benefiting. I mean, I mentioned it earlier. If you look at this year and you look at what industrials and materials are doing, so far this year, industrials are up 14%, and material companies are up 11%. So you're already seeing a rally. Remember, the markets are really efficient here, Drew. They understand these things much faster than most, and they build in those expectations pretty early on, and we see that happening within the market.
That's right. We've got a question about buying gold and the viability of that as an asset class relative to protection during market drops. What's the view of gold?
Yeah, they're not good for market drawdowns, but what they are good for is for inflation shock. It's really a play against the dollar. You know, if we have a period of time where the dollar gets beat up or a period of time where we have rampant inflation, it usually causes an erosion of the dollar. And in those time periods, you find gold doing extremely well. There is a high correlation between above expectations in inflation and gold performance. And I get asked every day, hey, if I think inflation's going higher, what should I buy? Well, the answer is it depends on how high you think it's going. if you think it's going to be a shock, gold is a great way to diversify that shock. If you simply think it's going to be a little bit higher than expected, then maybe Treasury inflation securities or even stocks, because stocks tend to earn money above inflation, even in the form of dividends. So there are a lot of other things that you can do, but that's what gold is really good for. That and apologizing when you upset your spouse.
That's right. We've got a question. You talked about foreign markets being something to diversify in. So the question is when do you do that? And are there specific ones, or is it kind of a broad diversified investment into foreign markets?
Yeah, look, the foreign markets can't be painted with a single brush, and I would definitely say be weary about just buying foreign markets, because what you're really buying is a third Europe, a third developed Asia, and then the rest is other stuff. When I look at it, I see the Eurozone as being a major developed world investment, and I see a lot of countries that are just bad investments and have been for a long time. Germany, France, Italy, Spain. They might have some performance pops here and there, but their performance is connected to their economy, and their economy is pretty weak, and their earnings are pretty weak. And I'm not a huge fan of Europe as it stands today. Now, there are some countries, things like Sweden and Switzerland, that look a lot better, where they're much more high quality markets. But then you take a step away from Europe and go into areas like the UK. And the UK has its own set of problems, but they're probably in a really good position because they now have the ability to take ownership of their own economy, where in Europe, you're basically trying to manage your economy with everybody else's. Japan long-term is in very rough shape because they're going through a massive population decline, and that's going to hurt their ability to grow their economy. But their economy is mainly tied to exports. And as long as the yen can stay low, it makes their exports relatively cheap. So for the Japanese central bank, it's been all about managing the yen, not high, but managing the yen low. They want to buy dollars and sell yen so that they can push the dollar higher and the yen lower to help their export business. So long term, there aren't a lot of places that are truly attractive. Then you have the emerging world, which is a third China and a third everybody else, it feels like. So the emerging markets are not what they were 10, 15 years ago. 10, 15 years ago, it was all state-owned bank and oil companies. Today, it's consumer, discretionary, technology. You still have commodity-based economies like Latin America and Russia, but you also have more technology-driven economies like India, China, Taiwan, Vietnam, areas like that. So there are a lot of really attractive opportunities. I prefer to have an active approach, hire a manager that lives in the area, that doesn't mind taking those bets on your behalf, because they're the ones that are there day to day.
Great. So one of the largest themes of the past 12 months was this, and for years now, actually, but as far as an investment alternative is cryptocurrency. So obviously a lot written, a lot of chatter, a lot of speculation about what the future is going to be with cryptocurrency. So how's AMS kind of approach and positioning client portfolios and the viability of that as an investment?
Cryptocurrency isn't an investment. At least not at this point, because it's not something that's liquid or even something we're allowed to own. It's been not allowed for banks, because if you think about it, with cryptocurrency, as a bank, you have to know who owns things, and you have this anti-money laundering where you have to be able to track transactions, and you can't do that in cryptocurrency. So stuff that goes down there is unseen, which makes the government nervous, and essentially it's going to get regulated at some point as soon as they can figure out how to do it, because they're going to use the Patriot Act by saying, we don't know if you're funding terrorism or not. So let's remove that part of the equation and just talk about, in general, cryptocurrency or the technology behind it, which is absolutely revolutionary, which is blockchain technology. And blockchain technology is what we don't talk about enough. And that's how you keep this stuff safe. And it's really, how do you keep secrets? That's what it is. And how do you make sure these secrets are truly safe? And the way that they've designed this blockchain technology is they take this encryption and they just break it up into all these pieces, and everybody has a little piece, and you have to have the right encryption key to put these pieces back together again. And it makes your own personal data storage extremely safe. And it's going to revolutionize the way healthcare works. It's going to revolutionize the way financial companies work, because it's going to allow us to have instant transaction, instant settlement, instant transparency. But the regulators are going to have to basically step in, and you can't call these things investments, because how do you determine the value of an investment? So at this point, Drew, my best advice is cryptocurrencies are not an investment, they're a speculation. I have no problem with speculation, but it's a speculation. You're hoping somebody's going to pay you more for it, because at the end of the day, it's not worth anything. You can't melt it down and use it in a process, and it doesn't produce a dividend, and it doesn't produce earnings. So you have to hope somebody's going to buy it from you. Unlike a lot of people in my business, I do think it is a fascinating technology that's not going away, but you are going to see some major reform and regulation attempt. I mean, the European Union's already moving into it with the ECB and the other European central banks. So look for more news on that. But there are some fascinating videos on YouTube that you can watch that goes through how the cryptocurrency market works, but it's very shady. So I think once you figure out that a lot of this stuff was written by Eastern European and Russians, you start to get an idea that there might be some shady stuff behind some of these.
Yeah, right. We've got one more question here, and then Jeff will hop on and close us out. Now, I think this is a good question to end on, because a lot of this discussion has been about, diversification, knowing yourself as an investor, risk, return. And so the question is, if stocks are going to outperform bonds over time, then what's the rationale for having bonds in a portfolio? Very simple question there, but I think a really good one for us to end on.
Yeah, look, I think if investors position themselves correctly, they may never need bonds. However, the reason that most people have to have some bond exposure is because bonds give you a known value at a known time in the future. And most people, when they retire, they need to have access to liquidity. They need to have access to their money. And while the stock market grows 70% of the time, it's up, 30% of the time it's down. When it's down, the last thing that you want to do is be forced to liquidate your investment to fund your living expenses. So bonds give you a way to have a known value at a time in the future that you're guaranteed by the issuer to get that exact amount. People shouldn't buy bonds because they think they're going to make money. People should buy bonds because they want to own something that has a known value at a known point in the future. And that's part of the financial planning equation. But this makes markets very easy then, because then you say, I own stocks where I want the money to grow. I own bonds when I know I have a liquidity event at some point. And it makes these things a little bit easier and more predictable.
Perfect. Nick, thanks so much. I'm going to have Jeff hop on here and close us out. But Nick, thanks so much for your time. This is really informative.
Nick, we're grateful for you. I was rereading Warren Buffett's kind of essays. It's been interesting. This is his 50th year, I think, of Berkshire Hathaway. So was dusting off the book of his essays. And it's interesting. We had an opportunity to go up there and visit when he has his annual shareholder meeting 4 or 5 years ago. And he reminded everyone here, listen, at the end of the deal, here's what you need to do. Have a lot of cash, have very diversified investments, and not be too aggressive. And I said, man, I traveled all the way to Omaha, spent 2 days here, and that's the takeaway. But 4 years later, that's a perfect recipe for good long-term investment for our clients. And so we're grateful for them believing and listening to that, and for your insight on selecting the investment. So we're stand by and ready to help. If you have any questions, we will email out to the people that we have email addresses that signed in the literature that Drew went through at the very beginning. We'll send that out today. And then if anybody has any questions or we can help, please don't hesitate to reach out to your advisor. So stay safe, be healthy. And Nick, thanks for your time.
All right. Thanks for having me on, Jeff. We'll talk to you soon.
All right. Bye-bye. Thank you.